Hey everyone, and welcome. Today, we are diving deep under the hood of a super popular investment strategy called momentum, and we're going to uncover a hidden and, frankly, a pretty fatal flaw inside a billion-dollar fund that was built to capture it. So, let's dive in.
Okay, so first things first, what even is momentum investing? Well, it's actually a beautifully simple idea. You just buy what's already winning. The whole theory is that stocks that have been doing really well recently are probably going to keep doing well in the short term. It's that old saying you always hear, the trend is your friend. Pretty simple, right?
And get this, it's not just some Wall Street hunch. For real, over long stretches of time, this momentum factor, as they call it, has absolutely crushed the rest of the market. It's known as the premier anomaly in finance, and you can see why. I mean, who wouldn't want a piece of that action?
So, to meet that huge demand, the iShares MTUM ETF was created. The whole point was to bring this powerful strategy to the masses. They packaged this complex financial theory into a simple product that anybody, with a brokerage account could just buy and sell like any other stock.
But here's the puzzle. If the strategy itself is so powerful and the ETF is built to capture it, then why in the world did MTUM, this massive billion-dollar fund, seem to just completely fall apart during some of the biggest turning points in the market we've seen recently? That's the big mystery we're going to solve today.
To figure this out, we have to pop the hood and take a look at the engine room. Because the answer isn't in the idea of momentum, that part's fine. It's in the nuts and bolts, the nitty-gritty of how this specific fund is forced to work. And it all boils down to a critical delay.
Here is our first major clue. The fund decides which stocks have momentum by looking backward. Specifically, it looks at how they performed between 6 and 12 months ago. Now, what's the problem with that? Well, by the time a trend has been running for a full year, it's often getting old, kind of tired, and sometimes it's right about to reverse. The fund is basically trying to drive forward by looking only in the rearview mirror.
And this rigid process is really the key to the whole thing. See, the fund only changes what it owns twice a year. That's it. Late May and late November. And notice step 3 there, wait. That's huge. It means no matter what happens in the market, a huge crash, an incredible rally, a massive shift, the fund is forced by its own rules to just sit there and wait, holding onto its old stocks until that date on the calendar finally arrives.
This timeline does a great job of showing the trap. So picture this. A hot new trend starts in January. Let's say energy stocks just take off. Well, MTUM is stuck holding last year's tech winners. As that energy rally gets hotter and hotter, the fund is just on the sidelines watching. By the time it finally gets to rebalance in late May, it's buying into a trend that's already 5 months old and totally crowded. It's late to the party, every single time.
Okay, so let's move from theory to what actually happened. We've got two, smoking gun case studies here. The huge market shifts in 2020 and 2022. This is where you can see how that mechanical flaw caused real, actual damage to investors' money.
All right, let's rewind to 2020. After that initial COVID crash, you remember all the work-from-home stocks like Zoom and Peloton? They went on this insane, historic run. But MTUM? Because that rally was so new, it completely missed the boat. It was stuck holding older, more defensive stocks that were basically going nowhere fast.
And this is where it just gets painful. On November 9th, Pfizer announces the vaccine and bam, the market flips on a dime. But later that same month, MTU has to follow its rigid schedule, so it finally rebalances its portfolio by buying the very work-from-home stocks that had just hit their peak. The timing was perfectly, mechanically awful.
The analysis on this is just brutal and so clear. It says the fund rotated heavily into these stocks at the precise moment the entire reason for owning them just vanished into thin air. It didn't just get there late, it literally bought the absolute top. Now, you might be thinking, okay, that was a crazy, once-in-a-century fluke, but it wasn't. The exact same pattern showed up again in 2022. The Federal Reserve started raising interest rates, the market shifted violently away from tech stocks, and once again, MTUM was trapped, holding all the darlings of 2021 as they were just getting crushed. So here's the bottom line. The fund became a bag holder. It was forced by its own rules to just ride those crashing tech stocks all the way down until its May rebalance date finally came. And while that was happening, it completely missed the explosive rally in energy stocks because, you guessed it, that trend was too recent to show up on its backward-looking radar. So what's the final verdict here? Well, all the evidence points to a fundamental, fatal flaw, not in the idea of momentum, but in the very structure of the fund. It's a structure that seems almost perfectly built to fail during any major change in the market.
So to wrap it all up, it's this perfect storm of problems. You've got the rebalancing lag we've been talking about. Then you've got something called front-running, where smart traders know the ETF has to buy certain stocks on a certain date, so they buy them first to jack up the price. And to top it off, there are these internal buffer rules that make it really hard for new, hot trends to get in and really hard for old, dying trends to get kicked out.
This quote from the analysis just says it all. This is the big aha moment. With MTM, you're not investing in what has momentum today. You are mechanically, automatically, by design, buying what had momentum half a year ago. And the ultimate consequence of all this is pretty chilling. This structural lag basically transforms a buy-the-trend strategy into a buy-high, sell-low machine. And it does it at the worst possible time, during those huge market pivots where fortunes are made or lost.
So we're going to leave you with this one question, because this isn't just about one fund or one strategy. It's a really powerful lesson about knowing the mechanics behind any investment you make. Before you put your money anywhere, do you truly understand the rules that your money will be forced to play by no matter what?